and I mean start reading. So please, I want to beg us for your class. You don't have much time. You have just little time, and every time that you have, make the most of it in reading your book. It's very, very important that you take note of that. Please don't joke with your book. I'm begging you now. Now we have looked at certain numbers of standards so far.
Why is being
Uh,
cold?
after tonight's, please mute your mic. After tonight's standard, I was hopeful that we're going to be able to look at two standards tonight, but time has actually gone. I just came back. I just walked into my house, and I think it's just barely 2 minutes, and I have to start the lecture. So we may not be able to deal with two of the standard, but all things being equal, we are going to still have about we are still going to cover about five more standards, and then the other ones you will read on your own. For emphasis sake, I told us the ones that we must read on our own. I mentioned it the last time, and I want you to please take note of it again. Let me mention it. Please, on your own, read IS2 inventory. It's a very simple standard. If you have any question, DM me, I will attend to you. On your own, read it. IS 20 government grant, read it on your own. It's very, very cheap. I'm begging you, read it. If you have questions, call me. IS 24, you have to read it also on your own. You have questions, please let me know. IS 24, and then IS 8, accounting policies, changing accounting policy, and the accounting estimates. Very simple standard. Please don't joke with them. Read it on your own. I'm begging you, this four standards, you have to read it on your own. And then hopefully by next weekend, we should be able to conclude, or let's say next 2 more weekends, we should be able to look at the standard. I don't want to rush you. I want to take it slowly with the standard, because I've discovered that they will be sent certain questions from those standards. So I don't want to rush you. We have, after this one now, we have five more standards to look at. We are going to look at IFRS 15. IFRS 15 talks about revenue from contract. We are going to look at IFRS 16. IFRS 16 talks about lease contract. We are going to look at IS 12. IS 12 talk about income taxes. We are going to look at IS 33, and that is earnings per share. And then IFRS 9, financial instrument. These five standards, you cannot miss question from it in any of the diet. These five standards that I mentioned. So don't miss the next classes. I'm begging you now. So by next weekend, hopefully we're going to look at 2 or 3, and then upper weekend we conclude the standards, and then we now move ahead to do the necessary to look at the other grid, which is the grid C, and that talks about the published account, as it were. So tonight, let's start again. We are looking at this standard called IFRS 13, and that is a fair value measurement. I told us yesterday that I wanted to skip this standard, but a lot of us may not be able to read it on our own and understand. IFRS 13, fair value measurement, is a standard, that IFRS need to bring to bear because of certain inconsistency in the manner and ways that preparer and presenter of financial information were using fair value. A lot of persons were using the standard with different concepts and the likes. But in the wisdom of ISB, they came up with this standard so that we can have what we call a one uniform approach as to how fair value measurement is meant to be. So that's why you see the name fair value measurement. And I told you, anytime you say anything like measurement, it means calculation. So how do you calculate fair value? That is the essence of this standard. And then from what we have looked at so far, you know that in IS 16 PPE, under the subsequent measurement, we talk about evaluation, and we talk about you using the fair value model. So it applies to every other standards that permit the use of fair value measurement. PPE is one of them. PPE subsequent evaluation under IS 16. And then under investment property, IS 40, we have looked at that. I told you that you have to measure the financial investment, your investment property at fair value. It also covers financial instrument. It should be measured. Financial instrument, it should be measured at fair value. Then, yesterday we look at FRS 5 asset held for sale, and I told you that you always use also the fair value measurement. IS 41, that is agriculture. Thank God I'm even seeing this now also. If you don't have time, we may not be able to look at IS 41 agriculture, but just in case we do not meet it up, add it to what you should also consider on your own. IS 41, very simple, standard. You have question, call on me also. So the IS 41 agriculture also allow that we should use fair value measurements. So FRS 13 does not tell us how to use fair value. It only explains how it should be calculated. And that's the overview as it were. So what exactly is even this fair value that we are talking about? What's the definition? You need to know it. It will help you a lot in the way you decide your professionalism, having learned and gained something from this lecture. You know, once we become a chartered accountant, even if you are not, as it stands, if you are in charge of those prepare accounts and the likes, you should know the definition. What is fair value? Fair value, in a simple word, simply means the price that will be received to sell an asset. That is, you want to sell an asset now. What is the price that will be received? Or if a liability is to be transferred, what will be amount to pay? In an orderly transaction between market participants at measurement dates, there are keywords here. The price, that is number one. The price that will be received. Now, look at this word, would. It is not that you are selling it, but if you are to sell it, that's why the clause if is there. If you are to sell this asset, the price that you will receive to sell the asset or pay to transfer the liability in an orderly transaction. Orderly transaction, okay, we'll look at them subsequently, between market participants at measurement day. So we have in this particular definition, the price, very important. We have orderly transaction, very important. Market participant, very, very important. And then the measurement date, very, very important. So let me take it from where we saw measurement date. Measurement date means the date of reporting, the date you are reporting. Take, for instance, a company calendar year runs from January 1st to December 31st of that year. December 31st of the year becomes your measurement date, which is also known as the reporting date. So reporting date is always the end of your financial year end. Market participants, they are the buyers and the sellers in the market. The buyers, the sellers, they are trade in the market. The orderly transaction simply means there is no coercement, there is no inducement, there is no unnecessary influence in the market. People don't even know that, for instance, you are in the market to do market survey. They are just doing their thing the way they are doing it. The person that is selling paper is just selling. You don't know that you, as an entity, you are coming there to price, to check whatever it is that is they are actually selling. That's why we call it orderly transaction. There is no influence, undue influence. There is no undue influence. There is no force. Everything is just working fine. And then you have what we call the price. This price is known as the exit price. Exit price, that is the price that an asset could be obtained for if you are to pay it today and not what you paid in the past. So this particular exit price is not looking at the historical cost of the asset, or the historical cost of the liability. Is actually looking at what will be obtained if you are to sell the asset today or pay to transfer the liability today. That's why we call it an exit price. Take note of that. Very, very important. So take, for example, now, a company that buys lands, let's say 2 million naira in the year. I mean, let me not be calling that amount because it's late. 2M. Let's say 2010 it was bought. And this is 2025. The land is now being sold for 15M. The fair value will be 15M. The purchase price is no more irrelevant. Why? Because exit price deal only with the current price, the prevailing market price, and not the historical cost or the historical price or the purchase price of that particular asset. So that's why we call it exit price. You can be asked to write on just a write short note on the following: exit price. Exit price simply means the price that will be paid to that will be paid for you to obtain an asset, or uh, pay to transfer a liability, in an orderly transaction, whatever, or you can go ahead and mention all those ones. But exit price, as it were, is what we look forward to receive when we either pay for an asset or transfer a liability, and not the historical cost of the asset. Please take note of that. So that's that for that. All of these things that I've explained, they are all in your material. So it's just as simple as that. So, like I was also trying to explain the other time, the measurement date is the date of reporting. Look at this illustration. An asset was purchased for 2 million naira and is currently being sold in an active market for 3.5 million naira at the reporting date. The fair value of that asset, irrespective of the historical cost, will be the one that is we have at the reporting date. What does that imply? You buy an asset now, like I was explaining earlier, 5 years ago, you bought it for 2M, and then you get to the market now. This is 5 years after. They are now selling it at 3.5. And then your reporting date, on that your reporting date, which is, let's assume, 31st of December 2025, that is your reporting date. They are now selling the asset for 3.5. The fair value of that asset is 3.5. That's that for that. So there are also what we call, that's that for the definition. Now, the key things that you need to know in Ifrs 13, you may need to jot that down so that in case I forget, you will remind me. The definition, you need to know it. That's number one, very, very important. Number two is the market assumptions. The market assumption, you need to know it. Number three is the valuation techniques. The valuation techniques is the third one that you must know. Very, very important. And then number four is the hierarchy. The hierarchy in fair value evaluation. You need to know that one also. Very, very important. And then the fifth one, which is important for you to know, is the high and best use when we are dealing with a non-financial asset. High and best use approach when we are dealing with non-financial asset. So those are the five key areas that we need to look at. Again, the definition is the price that you are to pay if you are to obtain, if you are to sell an asset, or the price that you will pay if you are to transfer a liability. The price that you will receive to sell an asset or pay to transfer a liability in an orderly transaction between market participant at measurement date is the definition. So that is that for that. The price that you will receive to sell an asset and then or pay to transfer a liability in an orderly transaction between market participant at a measurement date, that is the definition. Please take note of that. Take note of that. And so, like I said, the five things, the five key areas that we must cover that you must know, and the definition, let me take it again. The definition, the market assumptions, or the types of market, the valuation technique, you have the hierarchy, very, very important, the hierarchy. And then the fifth one is the highest and best use approach for non-financial assets. So those are the five key areas. We have dealt with the definition. Now let's go to the market assumption, or the types of the market. There are two major markets when it comes to fair value assumption. Remember, in the definition we said that the price that you will pay to receive, the price that you will receive rather when you want to sell an asset, or pay to transfer a liability in another transaction between market participants. Now, what is the market that we are talking about? You need to know the types of markets. Very, very important. So, IFRS 13 always assume that transactions occur in two major markets. Please take note of that. Two major markets. We have what we call the principal market. And the second one is what we call the most advantageous market. So please take note of that. Now, what is a principal market? A principal market is a market where there is an orderly transaction between market participants, and it has the highest volume. It has the highest volume of transactions and is the most active market if an entity were to sell an asset or is to transfer a liability. So the principal market, key things that you need to know that must feature for you to call a market a principal market is it must have the highest volume of transaction, that is, the volume of transaction is high. And then it must be a most active market where an entity can easily enter to say, okay, oh, if I want to sell my asset, how much will I receive to sell the asset? Or if I want to transfer my liability, how much exactly will I be able to transfer my liability? A very good example is if, for instance, you want to know the fair value of your generators, your plants, and your equipment, for instance. If you walk to Alaba market today, Alaba market is a very big market for equipment. Generator, any type of equipment you are looking for is in that Alaba International. You go there, you don't need to bother yourself much. Activity is high, volume is high in that place. Or the Harare market in Aba, for instance, now there is nothing you are looking for in that place that you will not get. Or you go to Onitsha market, there is nothing you are looking for in that place that you will not also get. Those are kinds of principal markets. So it necessarily may not mean all those ones that I mentioned. It may even be the market around where the entity is operating. As long as there is a volume of transaction in high density or most actively, then that market is what we call a principal market. Now let's look at this illustration. Now, before we look at let's look at the illustration. Alpha Limited owns a specialized machine which it intends to measure at fair value at 31st of December.
I don't know, maybe it's my network alone here, sir.
Can you all see my screen?
Yes,
Yes, sir. Yes, sir.
Yes,
Yes,
sir.
sir. Please.
Yes, sir.
Yes, sir.
I think it's your network still, please. So let's go and look at this illustration. We have Alpha Limited that owns a specialized machine which is intended to measure a fair value as at 31st December 2025. The machine can be sold in 3 different markets. Somebody say I'm too fast, so I will reduce. The machine can be sold in 3 different markets with the following details. Market A, B, and C. Market A, B, and C. Market A, the selling price in that market is 5.2. And then the annual transaction there is very high. And then market B is 5.4. Market C is 5. And then market C has a medium transaction. Market A and B has low transaction. The selling cost is 150, and then 120 for B, and then 100 for C's. You are required. They said required. Determine the fair value of the machine in accordance with IFRS 13. Now, because even from this question, they have already told you that the volume of transaction in market A is high, meaning that your market A is the what is it called, the principal market. And then there's even a clause here. They say Alpha Limited normally trades a market A. So that's why I put it in that this definition. They say if an entity were to sell an asset or transfer a liability, the market with that volume. So now these are the market at which an entity will usually want to transact, or they usually transact. There is high volume of transaction in that place, and that is the key things that you need to know. Like I said earlier, IFRS 13 is also one of the most simplest of all the standards. Very simple, but you need to know what is required of you. So for you to determine principal market, volume of transaction must be very, very high. And then if you have, for instance, market A and B, and they tell you that market A, the volume of transaction is 1,500, and market B, the volume of the transaction is 2,000. Now, by this, you should know that the volume of transaction is what will make you to determine the principal market, and that will be the one with the highest volume, which is market B with 2,000 as it were. That is that for that. So let's look at the solution I put here. I put it step by step so that it will also guide us. Step 1, you have to identify the principal market. Under IFRS 13, like I've explained before, principal market is always the market with the highest volume of transaction and level of activity. So from the question, Market A has high volume, B has low, C has a medium. Therefore, market A is the principal market. So what will be the fair value? We have to determine, remember, determine the fair value of the machine in accordance to IFRS 13. Your first step first is to determine the market, and then we have determined the market to be market A. Therefore, our market A is our principal market. So how do we now determine the fair value using the principal market price? According to IFRS 13, the selling price that is prevalent in that market will be our market price. Now, take note of something here. If you check this question, they say there's what we call selling cost. Selling cost. Selling cost. Now, when you are determining the fair value of an asset using IFRS 13, transactional costs are not considered. Please write that down in your note. Transactional costs are always excluded from the fair value measurement. You don't add it up. Except if they say is now included, that's when you will less it. Or they may ask you, you understand, to confuse you. They may tell you that in your question that in the purchase price, there is a transactional cost of this amount. You have to less it. And that's why we call it an exit price. We are not selling it now. But if we are to sell, how much exactly will be the value of the asset without the cost? And that's why you keep hearing me say fair value, less cost to sell. Less cost to sell. That is, if the amount is inclusive. Kizito, you are raising your hand. Please go ahead.
Good evening, sir.
Welcome.
There was something said about what we should note. Selling costs was are not being involved. Like something I didn't really get it, sir. Please.
Yes, you have to anything that is called transactional cost. Now there are two types of costs you always see in your IFRS 13 fair value. We have what we call the transactional cost, and we have what we call the transportation cost. Transactional cost and transportation cost. Now let's not jump. There is actually a section that I will deal with that very explicitly. Or if you want me to deal with that, so when we get there, we'll skip it. But it's better let's be taking it gradually like this. Don't jump. There's actually a space for transactional cost where you understand it better off. So let's go ahead. When I get there, you will understand it better. So that is that for that under the principal market. Please take note of what I've just said. Volume of transaction is very, very important. Now, please go ahead.
No, you said transactional costs are not always included. I didn't get it well. I was thinking you wanted to explain it now.
Yes. Transactional costs are always excluded from fair value measurement. That is, transactional costs, they include your legal fee, professional fee, consulting fee, all those fee. They are known as a transactional cost. They are not to be considered when you are determining the fair value of an asset. That's why we call it the exit price. That is the price that you would want to receive if you are to sell an asset. Now that you are not selling it, you don't need to give consideration to those transactional costs. You understand me now? That's why I said there are two types of costs in IFRS 13, transactional cost and the transport cost. Transactional cost you don't consider. But if the asset, for instance, will require that you need to transport the asset or it will involve locational differences, then you have to consider the transportation cost. You understand? But even when you are determining your the fair value under the principal market, whether the transactional cost, except if it's necessary, that's when you consider the transport cost. Well, anything that is called transactional cost, it must be duly and fully excluded in fair value measurement. You don't consider it. Please take note of it. Transactional costs are to be excluded. Don't consider it. But if it will involve what we call locational movement of the asset, you have to consider transportation cost if it is given. Is it clear enough?
Yes, sir. Yes, sir. Yes, sir.
Thank you so much. All right. So now let's go to the other one. That is the most advantageous market. Let's look at this in illustration. I think it's better. Let's not skip it. Illustration 2, under the principal market. Beta PLC owns a crude oil storage tank located in Warri. The tank can be sold in Lagos. Now, by using it now, they said this tank can be sold in Lagos commodity market at a quoted price of 8.5. However, the oil must first be transported from Warri to Lagos. Sorry, the tank, not the oil. No. The tank must first be transported from Warri to Lagos at a cost of 300,000. Broker commission on sale is 150,000. Lagos market is the principal market. Require determine the fair value of this asset at the reporting date. Now, we have seen this question. The first thing that I've explained to you that must come to your mind is, what is the principal market for this particular asset? We were told it's a tank, right? And then we were told that the only place that we can get an active market for it is in Lagos. Therefore, the principal market for this product will be Lagos. That is step one. Now, the quoted price, market price in Lagos is how much? Is 8.5, and that becomes the exit price for this particular tank. So 8.5 becomes the exit price. And then the second one is you have to adjust for the transportation cost. Now, remember what I've said. Remember what I've said. In this particular question now, we have, look at it, they say, however, the tank must first be transported from Warri to Lagos. That is what we call transportation cost. Then they said there's a broker commission on sale, which is 150,000. Broker commission on sale, which is 150,000. This one must be excluded, whereas the transportation cost must be included. So let's go ahead and see how to do it. Now look at it, adjustment for cost necessary to bring the asset. Okay. Now look at it this way. The market price is how much? 8.5. Less transportation cost of 300,000. Meaning our fair value will be 8.2 million. I've explained this in our previous classes. This should not be an issue to us now. Fair value less cost to sell. And I tell you that there are two types of costs: transportation cost and transactional cost. Transactional cost, exclude it, ignore it. Don't always consider it in your fair value. What you always consider will be the transport cost. If locational difference or inference will be of great consideration. If you have to consider the locational differences, then you must put the transportational cost in place. You understand me now? Why are we lessening transportational cost? To tell us the real value of what we can actually get at the end of the day. Because take for instance now, if you are actually going to sell that asset for 8.5, it means that the transportation cost must be removed from the 8.5 for us to get what exactly is the price that we will receive if we are to sell the asset. Why? Because somebody must bear the transportation cost. Don't get yourself confused. There are two types of costs when it comes to fair value. We have the transactional cost and we have the transportation cost. Every transactional cost, you must ignore it. Please take note. But when it comes to locational inferences, always consider the transportation cost. From this example that we look at, before the tank can even be considered for sale, you must transport it first to Lagos. So the price that you are going to receive at the end of the day, if you are to sell the asset, is the 8.5 minus the 300 transportation cost. Please take note of what I've just said. I'm sure it is clear enough now. Now let's go to the Ghanaian. Go ahead.
Hello, sir.
Yes, I can hear you.
Listen, I want to get you right. You said we have two types of costs. That's transactional cost and transportational cost. Are you not saying that whenever we are giving transactional cost, we are just to ignore it, we will not deduct? But
Yes.
transportational cost, we have to deduct that one from the cost
Yes.
to know the original
Yes.
cost. Okay,
Yes.
sir. Thank you, sir.
Favor, go ahead.
Good evening, sir.
Good evening.
Okay, so you mentioned something along the lines of we're not supposed to deduct transactional cost, and I think you also mentioned that things that fall under the transactional cost are things like legal fees, all of those.
Commission.
Yes,
Yes.
but I don't know if you can like really explain why we're not deducting it so that we get to like in-depthly understand why we're
Okay.
not deducting it.
Okay. Now, why you are not going to deduct is because it will always go to the hands of the third party. If, for instance, now you are paying a legal fee on, let's assume, on on what is it called now, rent. You are renting. Maybe I'm into a property now. You are renting from me. You are paying a legal fee. That legal fee you are paying is not coming to me as a landlord. It's going to the third party. You understand me now? But if, for instance, I'm to transport cement to the building, it is me that will bear it. Is that not so? It is me that will bear the transportation costs. You understand it now? So usually it is because that transactional cost will always go to the third party. You understand me now? And then it is not going to be considered because now what you need to understand is this. Don't look at it as if you are selling that asset. That's why we use the word would. If you understand, you are not selling it, but let us assume that you want to sell it now. What will be the price that you are going to receive? You are not. So that's why as a student, don't get yourself confused. You are not selling. But if you will, that means it is not a complete transaction. You are not completely going to execute the transaction. You are only giving it a consideration to have what exactly will be the worth of it, the value of the asset. That's why we call it recoverable. If you are going to sell it now, if you will sell the asset now, all other things being equal, what amount will be? That's what we call it the exit price. What amount will be in terms of the amount that you are going to receive? You understand? And if it comes to liability, at what amount will someone else will be willing to accept the liability without all of these transactional costs being involved?
Okay. Thank you so much.
All right. So that's that for that. So the second type of market, please mute your mic, is the most advantageous market, like I've said. So the most advantageous market, remember I said we have the principal market. The second one is the most advantageous market. The most advantageous market is the alternative market when there is no principal market. And this market maximizes the amount, the highest amount that will be received if you are to sell the asset, or minimize when if you are to pay to transfer a liability. Let me take it again. The most advantageous market is the market, the alternative market that exists, which maximizes the highest amount that will be received to sell an asset, or minimizes, when you are to transfer a liability. After this one now, you consider the transportation cost. Also, please take note, most advantageous market do not take note of transactional cost. Ignore transactional cost. You also to consider the transportational cost. Please take note of what I've just said. So first thing first is, if there are no principal market, remember, principal market is where usually the entity will enter to transact, and it has a higher volume of transaction, and the activity is high. So you don't need anybody to tell you what to do. Everything is just in order there. But then the most advantageous market is the other market that existed where principal market is not existing. And then for you to call it a principal market, it must be the market that they call it the market that maximize what we call the net proceeds. You understand? That you would have received if you are to sell an asset, or the net proceed that you would have received if you are to transfer a liability. So in a layman way, if you are using the most advantageous market and you are considering assets, so it will be the market with the highest net proceeds. Highest net proceeds. Net proceeds means that the available price, if there is any transportation cost, you less it, and then whatever you have will be the net proceed. That is the amount that you would have received if you have to sell the asset. Then, when it comes to liability, you look at the lowest, the minimum. That's why we say the one that minimize. That's the minimum amount. The lowest, if it's involve liability. It's as simple as that. So, how do you determine most advantageous market? Number one, for asset, like I have said, selling price less the transportational cost will give you net proceed. So the one that has the highest, you understand, amongst all of the available market. What we are saying here is this: let's assume that we have three. There are no principal markets. We now have three other markets, and then you have various prices in those three other markets, and there is transportation cost also for these three other market. Now we are considering asset. If there's a zone market B now have the highest net proceed after deducting the transportational cost, market B will become the most advantageous market. In other words, the price there will become the fair value price. If we were to be an asset, we are considering market A, B, and C, and then we are looking at which market we minimize the amount to transfer for our liability. We are going to consider, after when we look at the price, we remove the transportation cost. The one with the lowest will be the one that we are going to consider. Please, let me just be taking you in this layman way. Let it sink to you the way I've explained it. If you don't understand, call me back. I'm ready to go over it again, because it's been a while they bring this particular question. I'm expecting it in this diet question, one way or the other. So please take note of what I have said. If they bring asset for you and there's no principal market, for you to determine the most advantageous market, you look at the various market that is available. If it's asset, you consider the one that has the highest net proceeds. That is the market that has the highest net proceed as your most advantageous market. If it's liability, you look at the one that has the lowest net proceed to offset the liability. Are we clear enough? I'm sure we are clear. Now let's look at this illustration. Gamma Limited own industrial equipment. No market has dominant trading volume. The equipment may be sold in 3 different markets. You can see it here. The 3 different markets. Broker commission in all the market is 100,000. Determine the most advantageous market, fair value of the equipment. So by what I have explained, I'm sure we can easily do this very well. Is that not so? I'm sure we can, right? So now, before we go further, this broker commission in that market is what? What type of cost is that?
Transactional cost.
Transactional cost. What do you do with it? You ignore it.
Exclude it.
Thank you.
Exclude it. Ignore it.
Yes, thank you so much. So let's do it. Let me do this working, because as if I'm just reading notes. So let's do this workings together. So for the most advantageous market, I told you the first thing first is you look at the market, right? We have market. So you have a market. You have what else again? The price, and then you have transport cost. So, like I said earlier, the first thing first for you to determine the most advantageous market is you look out for the net proceed. So let's put net proceed as our last column. Net proceed. Net proceed. So we have let's put this one as TP. Our space there. I want to make it bold so that you can see it on the screen. That's why you see me. I'm using a very bold this thing. So net proceed. So now let's go. Market A. What's the price for market A? Hello. Are we still together?
4.5.
Okay. What was the transportation?
200,000.
200. So what will be the net proceed?
2.5. No, 4.3.
4.5. 4.3 rather.
Okay. Market B.
4.3.
Okay. So market B, what is the price?
4.3.
4.3.
43. What's the translational cost?
50,000.
50. What's the net proceed?
4,250,000.
Market C is what?
4.6.
4 point.
6.
Okay. What is the transportational cost?
400,000.
400. What's the net proceed?
4.2.
2.
2. So from this now, you can see that. So which one is our most outrageous market now? Number one is, ask yourself this: the item we are considering, is it an asset or a liability?
Asset.
It is an asset. So for us to determine our most advantageous market is the one that that maximize the highest of net proceeds. So from this our solution now, which one maximize the highest net proceed?
Market A.
Market A.
So market A becomes our most advantageous market. So what will be our fair value now? So our fair value now will be what?
4.3.
4.3. Do we all agree?
Yes, sir.
Yes, sir. We
So
do.
it's as simple as ABC. I've told you by God's grace, if I'm the one taking you, everything will be simple, simple. And you go to the exam, you write it simple, simple, and you come out. God will help us. So that's that for that. It's as simple as ABC. This is how your question will come. But if you don't know it, you don't know it. This is how simple it will come. The only thing there is, if you don't know it, it will look like something bogus. So that's that for that. So let's go ahead. There's nothing much there. That's the most advantageous market for us. So I wanted to discuss it: transactional cost versus transport cost. Transactional costs are always excluded from fair value, like I've mentioned before. Examples are legal fee, broker fee, commissions. However, when we have transportational costs, that means it's involving locational matter, so you have to consider it. So let's not dwell much on this. I've explained it very much. So let's go to the third aspect now. That's the valuation techniques. Valuation techniques. We have three major valuation techniques under fair value. Yes, I said for somebody is asking for the most advantageous market. If you are to determine it, when it comes to asset, you use the most the one that has the highest net proceeds. From this question, you can see it. Let's go back there. Somebody say I should go back. So let's go back and check. From what we have done here, which one has the highest? Market A that has 4.3. So 4.3 becomes our most advantageous market. Please take note. Don't get confused, please. Thank you. So, like I said, we have three major valuation techniques. We have the market approach or market technique. We have the income technique. And then we have the third one, which is the cost approach. So, the market approach look at the market price. What is the price in the market? The current market price of an identical or similar asset. What is the price? What is the price? For instance, you have plants that you want to fair value now. You just go to maybe around a market or a nearby market where you used to transact. How much is the current price of this generator? They tell you is 2,000. How much are you carrying in your book? 2,000, meaning what you have carried in your book is equal to what is obtainable in the market. But what you carry in your book, let's assume is 2,000. And then you go to the market and they say it is now 1,800. It means that you have overstated your asset by 200 as it were. So market approach or market valuation techniques look at what the market price is saying. So it's usually what you see in an active market or a recent sales of a similar asset. Take for instance, land that you buy 5 years ago. You understand? There is no active market for a land, but around that same area, you should be able to ask question: how much is the land going for? That alone becomes your market price. So usually, market price are not prices that you can say you want to be influencing. You can't influence it. It's always straightforward. It's always fixed, and that's why we choose it as an approach. So it's as simple as that. The market approach is the first one. Example: company owned. Okay, this is very common examples. A company owns a 10,000 shares, and then the market price of that share is 20 naira per share. Very straightforward. This market price, for instance, now, if a company is being traded on the Nigeria Stock Exchange market, your price of share will be there for everybody to see. You understand? So if you want to calculate the value of your share as at any date or any time, all that you needed to do is to know the number of shares that you are holding and check with the Nigeria Stock Exchange market how much are they selling my share. For instance, now, if I have share with GTB, 10,000, let's assume I have 10,000 share, worth of share, unit of share with GTB. I don't need to go to GTB to tell me how much they are selling their share. All I need to do is to check Nigeria Stock Exchange market, and they will tell me the price that the share of GTB is going for. And that alone will tell me the value of my share on a daily basis, if I want to be doing it on a daily basis or on a weekly basis. So usually there are no adjustments. It's straightforward. It's very easy, and there are no any undue influence. And that's why the market price seems to be the, when we get to hierarchy, we understand it better. It seems to be the highest level of hierarchy that is always being considered in the fair value. Like I also explained before, a land or a building, 5 years ago it was bought. You don't need to go to anywhere. Just go to, people are, how much is this worth now? They will tell you, and that becomes the fair value of the market price of that asset. So usually the market price approach is used for shares, for land, for buildings, for vehicles that that their prices are always within the range, is prevalent, is not influenced. It is what is always is in the market. So that's that for that. Then we have the income approach. The income approach actually believe that the asset will be generating future cash flows. You understand me now? That is, you are envisaging that if you continue to use this asset now, in the nearest future, in the foreseeable future, it will be generating some cash flow, and that cash flow is discounted into today's value. Why? Because the value of money in the tomorrow is not the same as at today. So this one actually uses what we call the discounting method. That is, discounting the cash flow from a particular asset or a liability into today's value. It's as simple as that. So let's look at this example. I just want a simple example so that you understand it. Is very simple. That's how your question will always come. And when you understand this basic, you can deal with them any way they bring it to you. Let's assume now, for instance, an asset produces 500,000 naira yearly for 2 years, and the discount rate is 10%. This is how to do it. You can determine your PV this way, or like I taught you earlier, you can do, let's say for year one equals to principal, which is 500 multiplied by 1. What is the discount rate? 10%. 1 plus 1 plus 0.1, that's 0.10. How many years? So this is for year one. You can put it -1 to power -1. You know the formula to always determine PV is always, let me put it here for the sake of those that are joining for the first time. PV is always equals to your P multiplied by 1 plus R raised to power -N. You understand? That's how to always determine your present value for each of the year. Please take note of that. So this is what it is. So give me figure now. Do this for me and tell me what the figure is. For year 2, are we still together? I want you to do it for those that you may feel the thing is cheap now. I say I I forgot the formula in the exam hall. But when you are doing it now, you will not forget the formula. Oh yeah, let's go. What do we have? Are we together?
Yes, we are together,
Yes,
sir.
sir.
So what do we have, please? Give me figure 500.
454.
We have 454.5.
So that's 4.455. Then this one is equal to what?
413.22.
413.
0.22.
Yeah, now let's do it this way. So total will be what? So your fair value will be equals to
That's 868.
868. It's as simple as that. Let's check what. So we have 867. So you can see. Let me put all.
Present value.
So you can see it's very cheap, right? Simple to use. Present value. Thank you. That's PV. PV is present value. Thank you. So it is always used for businesses or all these intangible assets valuation, like your patent, your license. You can always use the income approach to determine their fair value. You understand? For instance, the license now, if they give it to you, there are no any more advantageous market. The only thing that you will need to just look at is this license that they have given to me. How much will it be given to me? Let's assume in the life of the asset. Let's assume the life of the asset is 10 years. The life of this license maybe is 10 years. We did intangible assets yesterday, I guess. So, please mute your mic.
Scientific.
Mute your mic.
Mute your mic. So this license now, how much will it be given to me every year? You understand? Then you look at the cash flow, let's say for 10 years. Then you look at the prevailing interest rate, you can use it, or incremental borrowing rate, you can use it, and then you use it to find the present value of your cash flow. So that is that for that. Please take note of what I have just said. You can use the income approach for your business valuation. That's for forecasting. You can use it for intangible assets like your licenses and the patent right and copyright, and you can also use it for investment property valuation. That is just to know what the cash flow will be. What you need once you see a question under fair value and it's giving you cash flow, just know that you are going to use the income approach. This is a discounting method. That is discounting the future cash flow into today's value. And then the third one is the cost approach. Now, this one is looking at if you are to replace the asset, what will be the cost of replacing the asset? So it is usually cost to replace the asset minus any depreciation. Cost to replace the asset minus any depreciation. It's as simple as that. Okay, let me take it and recap it again. We have three main approach. The market approach, what the market is saying, the market price. The income approach is looking at the future cash flow from the asset discounted into today's present value. That is taking note or using the time value of money. Then the cost approach is looking at the replacement cost. If you are to replace the asset today, what will be the cost? And then minus any accumulated depreciation. It's as simple as that. Look at this example. The replacement cost of an asset is 4 million, and then it is used for 3 out of 10 years. Remember, it is used for 3 out of the 10 years. What will be the fair value of the asset? The first thing that you need to do first is to determine the depreciation on the asset for the first 3 years. So 4 divided by 10 will give us how much? Let's do it together. Determine So solution
That's 1.2 million.
1.2 million. But let's do it for the sake of. So first thing first is first step is to determine accumulated depreciation. Determination of accumulated depreciation. And so they said the asset is 4,000, and then the year is 10 years. So our depreciation per year will be equals to 4,000 divided by 10. That will give us how much? 400.
Yeah.
400,000. And they said the asset has been used for 3 years. So accumulated depreciation, accum will be equals to 400 multiplied by 3, which is equal to how much? 1,200.
200.
So our fair value using the cost approach will be equals to the 4,000 minus accumulated depreciation, and that will be how much?
3.
2,800. Is it clear enough?
Yeah.
Yes.
Yes. So that is that for that. We cannot have a question that will be difficult that you won't be able to handle with this simple example I've given to you. And that's why I bring up these simple examples. You understand now? So what you need to just look out for is once they give you a question, check if you are to use the market price approach, check if you are to use the income approach or use the the cost approach. The market approach, what is the prevalent market price? And usually the question that will always come under market approach are share. They tell you the share is this one, the share is this, this one has unit of share, or this is being sold for this also amount, or the land. They'll tell you similar land or similar property is being sold for this also amount. You understand? That's where you see. Then the income approach. Once you hear the asset is generating so cash flow, and for the next for say they may mention the year, just know that you are using the income approach. And once they give you the cash flow and the discounting factor, just know you are using the income approach. And whenever you are hearing the asset can be replaced for this also amount, the asset was bought this also year. Today is it has used 3 years or it has used 4 years. You just know that it will be that cost less the accumulated depreciation, and that will give you your fair value price. So those are the 3 major techniques that you can use any day, anytime. So that is that for that. So let's go to the fair value hierarchy. That's the 4th category, right? Fair value hierarchy. Fair value hierarchy talks about what we call the inputs to be used when we are valuing any fair value. When we are doing our fair value fair valuation, or when we are doing calculation for our fair value hierarchy, there are 3 levels. There are 3 levels when it comes to the hierarchy of fair valuation. We have what we call the level 1, level 2, and level 3, just as the name sounds. So we have what we call level 1 input, level 2 input, level 3 input. Dele, please mute your mic. Level 1, level 2, level 3 input. Please mute your mic. And the objective.
Dele, mute your mic.
Come on.
Yeah.
Dele, mute your mic.
Let's go ahead. Just don't worry about it. So we have level 1 input. That's why I call it level 1 input. This one now, before we come to this level 1 input, there is something I want to note here. The priority for this input, when we say hierarchy, is what can you observe? We have what we call the observable input and the unobservable input. Observable input are what you can see, what you can observe easily without any inducement, without any stress, what you can see. That's what we call observable. Unobservable is what you cannot see. For instance, market price is what you can see. You understand me now? You can see, that's why we call it observable input. But for cash flow now, you cannot see it. You're only projecting it. You understand? You are only projecting it. That one is an unobservable input. So we are talking about input now means information. You understand me now? When we say input, we are talking about information. So observable information and the unobservable information. That is what we use to, give hierarchy to the valuation techniques that we are using. So we have level 1 input. Level 1 input is this person is actually disturbing my ear.
Dele, also.
Mute your mic. Dele. He may be sleeping.
Maybe we should remove it.
Just allow him. So we have what we call. No, I'm using another this thing. So it's not primarily on my system. That's why I can't remove or mute him. I will have muted him. So we have the quoted price in an active market. Identical asset or liability. This one simple mean level 1 input is just know it. Observable market price. Observable market price. And they need no adjustment. A good example is the quoted prices in the stock exchange market. Yeah, the level 1 input, the quoted price in an active market for identical asset or liability, which can be measured, which can be reliably assessed or at a measurement data. They need no any adjustment. Yeah? For instance, the amount at which a share is being sold on the Nigerian stock exchange market is a very good example. They need no adjustment. And that's why we call them level 1 input. And this is the first hierarchy. This is the one you must give attention to first when you are doing your fair value calculation. In other words, if you are to determine your fair value now and they are giving you different information, the information that must come to your mind will be that you must give attention to, or that you must, use before any other one that you consider is the level 1 input, and that is the one that is observable in an active market that is no adjustment. And usually it used to be the quoted prices in an active market. So they are used for listed shares, government bonds, all these government commodities. Then we have the level 2 inputs. Level 2 inputs are all other observable markets apart from that of level 1. That's the definition. All other observable input that is not observable in level 1, directly or indirectly. Directly or indirectly. So a good example is your land and building that you have, they are not quoted and the likes. They are not quoted as the like, but they are what you can observe within your environment, or the price of what is it called, of your plant and machineries that they are being sold in a very active high level market. You understand? All those ones, they may be subject to adjustment, and that's how we call them level 2 input. So level 1 input, they are not adjustable. Level 1 input, they are quoted market price or prices that cannot be induced, prices that cannot be adjusted. Observable information or input that cannot be adjusted. Sorry, please, we'll soon round up now. Just don't mind them, Daily. It's asleep. Yeah? So we have Example, okay, that's level 1. So we have level 2. Sorry. The level 2 now. That's what I've just explained. Then we have the level 3. The level 3 is unobservable input. The market with an unobservable input. So level 1, observable, no adjustment. Level 2, order observable with adjustment. And level 3 is the unobservable input. So they're always based on what we call management assumption. That is, they get what we call data from unobservable sources. Like I said, the what is it called? The cash flow is a very good example. So that is the hierarchy. So please note this hierarchy very well. I'm begging you. Level 1 input, level 2 input, level 3 input. Level 1 input is observable market, observable prices that cannot be adjusted. An example is the quoted prices on the Nigerian Stock Exchange market. Level 2 input are the other observable input apart from that of level 1 input. Other observable input apart from level 1 input, and there can also be market prices that may be subject to adjustments and the like. The level 3 inputs, they are all the unobservable inputs. They are always determined by assumptions from the market or the management. So they are unobservable as it were. So example is your cash flow. That is that for that. So in the note, I give a summary of how to always identify them. So you can always see it here. Level 1, market price. Level 2, market comparison. You still need to do comparison and the like. Number 3, management estimates like your cash flows and the like. So it's as simple as that. So we have the final one. That's the highest and best user approach. This is actually used for non-financial assets. Non-financial assets, they are assets that you don't there is no contractual right for you to receive cash when you are using them. They are being used in the operations, in productions, and the likes. You don't expect that you are going to receive cash from them. Example is when you come to use them in your operations, in your production, they will not give you what we call cash. An example is land and building, plant, motor vehicle, inventory, and the likes. What are financial assets? Financial asset includes cash, your bank balances, your trade receivable, your loans, investment in shares. You understand? All those ones are financial assets. So your non-financial assets, they are more or less like what you use in the ordinary course of your business. The non-financial assets, they are what you use in the ordinary course of business. Now, in the wisdom of IASB, they made us understand that you can also you may choose not to use the 3 techniques that we gave under the evaluation techniques. You may choose not to use it. Rather, you will now use what we call the highest and best user approach. They call it highest and best use. Why? Because you must compare their markets. You must compare the market of this non-financial asset and choose the one with the highest value. You choose the one that is with the highest value. Dele, can you please hear me? Mute this your mic. So the key principles when you are dealing with this highest and best use is number 1, you need to know the market participants that will use the assets. Now, please note, this is always used for asset, not for liability. It's always used for asset and not for liability. So fair value, you determine the fair value by first of all considering the market participants, how they will use the assets. How they will use the asset. You understand? And then you have to look at how the entity also is currently using the asset. If you are to trade up the asset, how will the market participant use the asset? If that's the first leg to it. Then the second leg is how is the entity currently using the assets? You understand? That's why we call it highest and best use. So there are 2 approaches here. We have the highest, that is the one that gives the highest return. And then the second one is how it is being used. Very, very important. That's why they call it highest and best use approach. However, there are conditions before you can value the assets using the highest and best use approach. 3 conditions must be met. These 3 conditions, all the 3 put together, must be met. Number 1, it must be physically possible for you to use the highest and best use approach. It must be physically possible. That is to say, the asset, you must be able to determine the size, the shape, the condition, and the location of the asset. You understand now? In other words, the size, the shape, and the condition and the location of the let's even talk about the size. The size of your asset as an entity must be the same size with that one in the market that you want to compare it with, because that is the market participants. They are always in the market, right? The size, the shape, the condition must be the same thing. You understand? And the location must be the same place. Take for instance motor vehicle as an instance now. Your motor vehicle that you want to compare, you understand now, they must be of the same brand. It must be Toyota Corolla 2018, the same size, the shape, the condition must be the same, and the location, of course, it must be, let's assume maybe Abuja now. That means the vehicle must also be in Abuja. You understand me now? So that's why we say it must be physically possible. It must be physically possible. Number 2, it must be legally permissible. That is, the law must allow that transaction to take place. If the law do not allow it, it means that you cannot use the highest and best use approach to value that particular asset. And then the third one is it must be financially visible. That is, the return must be higher than the cost. The return must be higher than the cost. The return must be higher than the cost. Must generate adequate returns after the cost. So these 3 things are very, very important. You may not need to know the meaning, but just know them. I call them the PLF. The PLF. Don't forget, if you want to write, you can put it down. PLF. Physically possible, legally permissible, financially visible. These are the 3 criteria for any non-financial asset to be valued using the highest and best use approach. It must be physically possible, it must be legally permissible, and financially visible. Return must come. What are the rules? Number 1, check. If you are to use the highest and best use approach, you must check the 3 conditions if they are fully met. They give you a question that you should value using the highest and best use. You must check first the 3 conditions if they are fully met. Then the second one is you must be able to determine, when there are more than one use for the non-financial asset, that is, you have more than one use for the non-financial assets. Use the one with the highest value, that is, after deducting all incidental costs, every incidental cost attributable, after you have deducted them, you should use the one that is generating the highest in value. What I'm trying to explain here is this. Once you are given a question, check. Number 1, are the 3 conditions met? Number 2, go and check. If there are more than, for instance, now, you may have a building, and the building may be situated in a particular location. And in that location, the building may be used for a shopping complex. The building can be used for rental purposes. The building can be used as maybe your head office space. You understand? That's how we say you look at the usage. You understand now? Now, for you to determine the fair value for that particular asset now, for this particular building, you need to look at the one with the highest value in terms of, if for instance now, if you're going to use it for shopping complex, how much will be the return? Let's assume it's 8 million, 8M as it were. That if you're using for shopping, let's assume it's 8 million. And then if you're using for rental purpose, let's assume maybe you're going to be getting 6 million. If I want to use it for your head office space, you will not get anything. So you look at the best possible value that you are going to get, and that will become your fair value price for that particular non-financial asset. For instance, in this instance, we are looking at building, meaning the one with 8M will become our fair value. Is it clear enough? Now let's look at this illustration before we take questions. Delta Limited owns land currently used as a warehouse. That means Currently, they have a land. That land is being used as a warehouse. But the following valuation are available for the warehouse. That is, the warehouse can be used for the following. One, the warehouse can be used as warehouse. And the value, if you are to use it, is 8 million. It can be used as residential estate. That's the land now. Can be used as residential estate. And the value is 12 million. The land can also be used as a shopping complex. And the value is 15 million. Additional information. Always look forward to that additional information. We were told that the local planning authority permits only residential and warehouse for the use of the land. Development costs for a residential estate are estimated at 1.5 million. Shopping complex is not legally permitted. Determine the fair value of the land. Now, with this, first thing that must come to your mind is, are the three criteria met for the use of this particular land? Land is what we are considering here. If you are to look at it, the land can be used for warehouse, residential, as well as a shopping complex. If we are going to continue to use, if we are going to use this land for warehouse, we are going to get 8M. If we're going to use the house for residential, so we're going to get 12. If we're going to use that for shopping complex, we are going to get 15M. But are the three criteria met? The PLF, are they met? The PLF, are they met? That is physically what? Possible, legally permissible, financially visible. Are they
legally not legally permissible?
So the warehouse and residential, they actually meet the three criteria. But the shopping complex did not meet any three. The shopping complex, was left out. If you check this question, they say shopping complex is not legally permitted, meaning the other ones are legally permitted. You understand me now? And I remember I told you that when we have more than one alternative use for a particular asset, you have to choose the one with the highest value after you have deducted all incidental costs. Remember, I said incidental cost. When you have deducted all the incidental costs. Now, we have how many? We have, in this question, we have development cost for residential to be 1.5 million. So, if we are going to do this particular thing now, the first thing that we are going to do is to, determine the highest value for the asset. Determine the highest and best use of the asset, of the land. But one thing that must come to your mind is the land cannot be used for shopping complex. Why? Because it is not legally possible. Is that not so? But the other two options are still available for us. Is that not so? So now let's look at the net proceed. Now we're told that if we are to use it for the warehouse, let's do it where item. Then you have proceeds. So for the item we have warehouse. If it's going to be used for the warehouse, we have 8,000 as a proceed. And if it's going to be used for residential, what will be the proceed? How much is the cost? That's 12,000 minus incidental. That is incidental cost of 1,500. So how much would that be now? Are we still together?
10,500.
10,500. So what would be our fair value using
Residential.
10,005 will be our fair value because it's the one that is using the asset, is the one that is generating the highest value, as it were. So that is that for that. It's as simple as ABC. Any question? Is it clear enough? I'm sure it is clear. The disclosure, very, very important. Always learn this. You see, when they say disclosure, you may not need to read it, but once they ask you any question on disclosure on any standard at all, just look at what is in the definition, all those things, what is the measurement, put it down for them. You understand? You don't need to cram it. Entity must disclose violation technique, the hierarchy level, the level 3 reconciliation, that is, how do you reconcile the 3 levels? Then you can put there sensitive analysis that is done, that is, in terms of generating the cash flows and any other assumption. The purpose is for transparency. So that is everything about the disclosure. So IFRS 13 is as simple as ABC, and you have covered it. Any question they ask you, you must not fail it from today. So whenever I'm discussing in class and I'm talking about fair value, you're able to understand what it is all about. It's as simple as I have explaining to you now. Any question?
Yes, there's a question.
Please ask your question.
Okay, sorry, because this is my first time joining the class.
Okay.
This disclosure part, I'm not so clear.
Okay.
If they ask us for the disclosures, is it that we're going to list out all these things, or I don't know?
Yes.
I just want
This is
to
how you
know.
are going to list it out. When they ask you for any disclosure, when you are looking at any standard and they say disclosure, just look at what is in the definition, what is in the measurement, and the recognition, whatever, and put it down for them. Nobody will penalize you. We have looked at all these IFRS 13, and everything that I put down there, they are all in what we have explained in the definition, the recognition, the measurement. Is that not so?
Okay.
So that's how to just list it for them.
Okay, thank you.
You're welcome. Any other question? Was it allowed? Would you go ahead?
Hello, sir. Can you drop
Thank you very much, sir, for the. Hello, sir.
Just hold on, please. Let
Hello.
Moses Holiday. Joshua, please
Thank
hold
you
on.
very
Let
much.
Moses finish. Moses, go ahead. You said?
Thank you, sir. Thank you very much, sir, for the lecture. God bless you. Please, as I said, up till now, I don't know what happened with my this thing. I couldn't see your screen up till the end of this. I don't know. I want to find out if though I've not paid for the material, if I've paid for the material, all the questions treated and the solutions, are they already embedded in the materials? Will I be able to find them there?
They are all embedded in the material. What I just do is to fine tune it, and then it will be uploaded. So if you check your material for this time, they are all being updated. I didn't share them in piecemeal. I update them so that it will be like a one piece material for you to be easier and seamless. You won't miss out anything. Everything is there as it were, as it is.
Thank you very much, sir.
All right, Joshua, you can go ahead.
Hello, sir.
Yeah, I can hear you. Please go ahead.
I was asking, I said, whether can you drop the recorded video on the platform?
Yeah.
Because I came late.
Yes, it will be dropped by at least between now and the morning. It will be dropped. There is just a little hiccup. That's why we didn't drop that of yesterday. Like I told you, to be dropped at least between now and tomorrow morning. You will see them on the playlist.
Okay, thank you, sir.
You are welcome. So, any other question? Okay, go ahead.
Sir, mine is not a question, please. Yesterday, like we treated IS 38, I think so.
Yes.
38 and IFRS 5, isn't it?
Yes.
Thank you, sir.
All right. So we're able to do 3 standard this weekend now. Please sit with them. So far, so good. We have looked at about. All right, Fasik Ayobami, go ahead. Why are you bearing my name? Ayobami.
Yeah, good evening, sir. Thank you for the lecture.
Thank you.
I think from the beginning of the lecture, you said maybe you've given us all those important standards to go through. Though maybe I wasn't I wasn't in class then, so I didn't know whether you can just help us either to mention them again or just to drop
Okay.
it on the group.
All right. So let me quickly recap on everything now. Just 2 minutes. I won't stay more than 5 minutes. So all your questions will stay within. So just allow me. We have been able to look at some standards. We have looked at IS 16 PPE. We have looked at IS 36 impairment. We have looked at IS 40. That's investment property. We have looked at IS 38 intangible asset. We have looked at IFRS 5, asset non-current asset for sale and discontinued operation. And then we have looked at what is it called now? IFRS 13. And that is fair value less cost to sale. All of these six standards that I've mentioned, they are what you will need in your statement of financial position under the asset, the non-current asset. You can't do away from you can't do away with all of these six. That's why I have to treat it first. Now, I wanted to go and read the following four or five standard on your own. Let's just say four. Very, very important. I wanted to read IAS 8. Number one is IAS 8 on your own. It's very, very simple. If you have any question, call me or DM me. I will attend to you. I want to read IAS 8 talks about accounting policy, changing accounting policy and accounting estimates. Then IAS 2, that is inventory. Please read it. It's very, very important. Very, very simple. Then you have IAS 24, related party. Very, very simple also. Then you have IAS 20, government grant. Very, very simple. So those are the four main standards that I want to read on your own. We are going to look at, if you add that 4 to 6, that's 10, right? And I told you we are going to look at 15 standards, right? So we have 5 more standards to look at. And that is IS 33 EPS, IFRS 9, financial instrument, IS 12, income taxes. We have IFRS 16, that's lease contract, and then IFRS 5, revenue from contract. These 5 that I've mentioned, you cannot escape question from. These other 6 that we have looked at, you may not see them as maybe a whole question. You understand? But these other 5 that I mentioned now, be rest assured at least 2 of them will come in your exam as a maybe 20 mark, 15 mark, 10 marks question. You understand? So please don't miss class.
Mention the first again, please.
The other, which one now?
You said the 5-1 mentioned. So I didn't get it, please.
IFRS 15, revenue from contract. IFRS 9, financial instrument. IS 33, earnings per share. Which one again? IS 12, income taxes.
IFRS 9.
I've mentioned IFRS 9. There are 5. IFRS 9, financial instrument. IFRS 16, lease contract. IFRS 16. IFRS 16, lease contract. IFRS 15, revenue from contract. IS 33, EPS. IS 12, income taxes. Let me say it again. IS 12, income taxes. IS 33, EPS, earnings per share. IFRS 9, financial instrument. IFRS 15, revenue from contract. IFRS 16, lease contract. Please, we should be able to look at them in the next 2 weekends, and then I think we'll be done with everything that is called standard. That means we are now going to be 50% done with our class, and then we have 50% more on to go. Then also, I think we are moving faster this time around. But please, I'm begging you, read your books. I'm begging you, please read your books. Start summarizing, solving questions. Look at the one we have looked at so far. Solve questions. Look at all for past questions. I hope I've been able to impart knowledge again tonight. I want to thank you sincerely for your time. And may God crown all of our effort with success. Abba, may I see raising your hand?
No, sir. No, sir. No, sir. Thank you so much, sir.
Okay. All right. Thank you so much, everyone. Have a
Thank
very
you, sir.
wonderful interest.
Good night.
Thank you, sir.
Thank you, sir. Good night. Good night. Thank you very much, sir. God bless you also.
Bless you.
Thank you, sir.
Good night.
Thank you, bossman.
Thank you, sir.
Hello, please, if someone can hear me, when is the class starting?